Hey everyone, this is Eric with Onramp Funds. Thanks for watching Create Something with Onramp. Today we're going to talk about the cash conversion cycle. At the highest level, cash conversion cycle is how much cash you put into a business, and then the investments you've made will generate revenue, and then that revenue will cover costs, and the gross profit less than the OPEX gives you your net profit. That whole cycle then is what we're going to go talk about. When we think about deploying cash, let's just take it in the simplest sense from an e-commerce perspective. We buy inventory in bulk. We have that inventory shipped from our supplier. It arrives at a warehouse. It's broken down so we can sell each discrete piece of inventory, this pen for instance, to a retail buyer, and then rinse and repeat that process over and over again until it's time to buy more inventory to make sure when those future pen orders arrive that you have the inventory in stock necessary to deliver that. As we think about then that cash conversion cycle, we have tied up cash and inventory. That inventory cost is probably, for the average e-commerce business, going to take about 60 to 120 days to cycle that inventory out. Midway through that process, you will deploy more cash for more inventory to make sure that you don't run out of inventory so that you can always process that next order coming in. As an inventory arrives, you will then pay for advertising expenses. These advertising expenses, pay-per-click ads on Amazon, other marketplaces, on Google, on Facebook to drive somebody to come buy that pen from you. It's going to cost you incur prior to generating revenue on that specific pen, which means you have to have the cash available for that. Upon the successful completion of that order, you're then going to be charged shipping and fulfillment fees. You have to get this pen into that box with that shipping label on it from your warehouse to your customer's home so that they don't charge that product back to you. We've now completed the full cost of goods sold cycle, which now means that the money left over from what you charge for that pen after paying for the inventory cost in that pen, the advertising, shipping and fulfillment, payment processing fees, which just come out when the deposit's made to you. That's your gross profit. You're now ready to then go spend money on your operating expenses. Those operating expenses, salaries, other sales and marketing efforts, warehouse space, shelving in your warehouse where you're gonna put those products. All those expenses are then covered over time, piecemeal as each order comes through. And then as you kind of look at that coming through the system, we finally have our net profit, which for the emerging small business owner that's creating their business in the e-commerce world, that net profit is generally the salary upon which you're living, paying your living expenses, paying your mortgage. That cash conversion cycle for the average e-commerce business is going to be about 90 days. Super highly efficient businesses might run that as short as 35 days, although in the COVID cycles right now with supply chain timelines, that's really unlikely. What we're seeing these days is really more about 120 days average because of some of those delays. That means you need sufficient cash on hand to be able to generate that gross profit, to be able to pay those operating expenses, to be able to pay your net profit salary to yourself, to really kind of keep you going for 3 to 4 months as you cycle through that. One of the other important things to think about with that cash conversion cycle is as you're running profit, you will have taxes. Unfortunately, many states and the IRS often view inventory as an asset value. That asset value is then taxable at the end of the year. So it's really important to also take that into consideration in your cash conversion cycle, because you may actually need cash for those tax liabilities that are far lumpier cash flows than, say, inventory, where it's turning over and recirculating and recycling over time. As we think about the cash conversion cycle, this is where many, many businesses get really in a hole. From an accrual perspective, a slow cash conversion cycle still looks like a highly profitable business. But if that cash is captured in inventory, if that cash is captured in those cost of goods sold expenses, and you're not able to generate sufficient gross profit to then cover the operating expenses, or you're not able to you're generating good gross profit, but the cash flow timing isn't coming in when you need it to cover your operating expenses, you're then going to have challenges in terms of meeting those payroll expenses, legal bills, accounting bills, things like that. So it's really critical as part of this cash conversion cycle that we use good cash flow management tools, which we talked about in a separate episode. These include things like digital tracking of all the stuff going on in your business, really making sure that's tied into your QuickBooks or your other other accounting systems so that you've got good visibility into that you can work with your accountant very, very closely on this, that you're prepared for what those taxes are going to be, and that you can then really run an efficient cash conversion cycle. We can go much deeper into this in future episodes. We have content experts on small business finance, small business cash conversion, small business accounting that we'll be offering in future episodes. Thank you for watching today. This is Create Something with Onramp. Please subscribe, and we'll see you again soon.